Hi, it's Kylie Davis from the PropTech Association here, and it's great to have you on this webinar talking about technology and brick by brick property development and what we've seen over the last 12 months. I'm joined by Delwyn Sela from MPSS. I'm also here with Robert Bathke from Newground and Jim Castagnet from Versailles Capital. So, gentlemen, what we're going to talk today about is what the last 12 months has been like in the property development and investment space. What have you guys seen? Well, how has COVID affected the market and investing in property?
Sure. Shall I kick off with an introduction?
Go. Yeah.
Thank you. So, hi everyone. I'm Jim Castagnet, Managing Director and co-founder of Versailles, a funds management company which I established to drive development activities a couple of years ago. Now, I've been developing medium to high-end residential developments and mixed-use developments, in fact, for the last 20 years or so. During that time, I've successfully developed and led, I think, just about over $1 billion worth of projects. I'm an educator, and I founded property development workshops in 2004 to educate people in property development. I'm also the author of the book Build, and I have featured as a guest on Sky Business Real Estate News. And I'm very excited to be here today. Cool. Would you like me to answer the question?
I think so. So, Jim, what have you seen? How's the last 12 months been in terms of property investment? What have you seen? What has transacted well? What hasn't?
Sure. Look, I guess let's address the elephant in the room, if you like. Now, and I'm talking about COVID. So, I believe COVID, at the end of the day, will have a positive effect on the property market. Indeed, I was predicting in mid 2020 that there would be a strong recovery as we live to learn to live, I should say, with COVID. In fact, this is the case. And it's been the case with all previous 5 shock events that have happened since the 1980s, including the share market collapse, SARS, the GFC, etc. Now, back to today, according to CoreLogic, the year-to-date prices for houses to August 2021, which is last month, house prices have risen 23.3% and units 11.5% in Sydney. Now, nationally, those figures are 17.8% and 9.3% respectively. So I believe the upward trend in prices will continue. I believe not so much because of COVID, but because of the supply and demand equation. And in the short to medium term, there will continue to be a short supply of dwellings, particularly when immigration resumes in full swing. So look, I'm very optimistic about property development, especially residential developments as an investment opportunity. And I've got to say, at Versailles, we are very keen to offer investors an early harvest strategy, meaning high returns in a short time frame to capitalise on those opportunities.
Great. So, Delwyn, just do a quick intro and tell us what you've seen over the past sort of 12, 18 months and how COVID's impacted the market.
Thanks, Kylie. So, sure. My name's Delwyn Sela. I'm the licensee of My Property Solutions Sydney, or MPSS. We specialise in property management, and that goes across residential, commercial and some industrial property. And I think the advantage for that, for the benefit of people listening to this, is that we're in the marketplace on pretty much a day-to-day basis. In terms of, what are our comments going forward, I've got to admit at the beginning of the process, everyone thought, I think COVID was going to be a disaster, particularly for asset-light property, and we mean residential housing. As it's turned out, it's been exactly the opposite, and it seems to have spurred a drive for people to acquire, particularly residential property. And oddly enough, it's seen an adjustment in the playing field for commercial property. So in the last 3 months in particular, we've experienced a large amount of inquiry, believe it or not, for commercial space, and also for investors looking to purchase commercial property with long-term horizons. To add a little twist to that process, we've recently been involved with some short-term rental companies and they're seeing an upswing into the future as well. And they're busy out looking for properties to ideally rent or acquire to rent on the basis that they feel there'll be an influx of people back to Australia once the vaccination process has reached its peak. So having said all of that, I've got to agree with Jim. I think the future is optimistic. It's good. I'm as surprised as everybody else, but happier, of course, because I'm a real estate agent, that property is moving forward. The only thing that's a little bit tricky on the horizon is rental yields continue to decline. So I think that's an indication that prices are fairly full. But having said that, certainly at this stage anyway, supply does not seem to fit in with the demand for property.
So Robert, tell us a little, just give yourself a quick intro and tell us what your experiences have been.
Robert Bathke, Associate Director at ICG Newground. We are fund managers involved in various sectors of the commercial real estate industry, so not simply residential, but throughout. What we've seen is that there are both winners and losers in terms of COVID. Losers are fairly well documented. Big retail malls and retail holders, and the clear winner being industrial and particularly logistics. Residential has been another winner for the reasons that have been mentioned before. Definitely seen an uptick in market, particularly in the more recent months, and an increased level of inquiry, and that is due to a large number of factors, some of which are commercial banks pulling back and being more conservative, which opens up a bigger market for us as institutional / private lenders. So that's been our experience.
Do you think that as we look at the market, we're kind of at the bottom now? Because we look sort of down the crystal ball of what's coming. We're about to hit critical mass in the next couple of months around vaccinations. Borders have got to start to open soon by the end of the year. We've got to, I tell you what, when they do open up, we're going to hit the shopping malls so hard because everyone has been so desperate to do any shopping that wasn't just, a quick dash and grab at either Dan Murphy's or Bunnings. What do you think that now, if you're looking at that commercial property market and retail, that now is the time when people are starting to act because we are kind of bouncing along the bottom?
It would seem so. I mean, if you look to Europe and the UK, they've just had their summer holidays, and everyone there seems to have been off all over the world, and so very much an open border as opposed to a closed border philosophy, given that they're out of lockdown and a fairly high vaccination rate. So it would seem to be so. Whether everyone runs back to the malls, I don't know. I think
I'm going.
Well, a lot of people aren't. If you have a look, and I just use the UK as an example because one might say that they're a couple of years ahead, and that Australia might follow a similar path, and they're sitting at 25% of sales being online based, and we're sitting at as far as I know 15%, and so have got a way to go to get up to their level. So there's an element of thinking that says that COVID accelerated a transition that was happening and already in progress. It simply was an acceleration to where we are now. And what that's done is, in our minds, created sort of the winner and loser camps, and changing nature, where we've seen our neighborhood retail centers becoming centers for last mile logistics. And the reason that I say that is because Coles and Woolworths, for instance, will on their click and collect, or they will actually use their stores as their source. And so that's a change that we're seeing.
We have seen a lot of changes through this period, haven't we? And while being locked down is never fun, the change towards working from home, even if it's just some of the time, has been pretty, universally embraced, especially in white collar jobs. Delwyn and Jim, how do you think that's going to impact on commercial property values as we come out of, and commercial property demand as we come out of it?
Well, look, in terms of on the ground, it's, as you know, there's so many different classes of property, it's hard to be specific about it all. But commercial property, high-rise buildings where there's a lot of people, lift access, that's certainly under pressure. Because many people are at that stage where they're saying, well, look, if I can do something at home, I will. Employers seem to be encouraging that process as well. There's instances of large commercial development in the city of Sydney where those firms are basically turning around and saying, we'll bring in half our workforce for 2 or 3 days and the other half for the balance. So that's definitely going to impact on those large-scale commercial processes. At the other end of the scale, you've got smaller scale commercial retail, for example, where you've got a single tenancy, a strip shop, something along those lines, and they're really dependent on lease. So if there's a good solid lease, you're going to get a good multiple, a good return on your commercial property. If you've got a lease that's out of kilter with current rentals and also in terms of its clauses that might be a bit archaic, then you're probably going to see some renegotiations, and I think some values will come down. In residential, none of that seems to matter. People are basically just saying, look, I need a property, I need it now, and it's fear of missing out, I think, that drives the market. And I think the only thing that's going to change that realistically is affordability. And, you know, when it gets to a point where it's not affordable anymore, then you're going to see change. So again, to echo Robert's speeches as well, it really is a case of winners and losers, and you've just got to be a bit selective about the direction you're travelling.
But Jim, what's your view on that?
I'd love to just make note of some of the trends that are happening, in particular with the workforce. Now, there's been a lot of migration from cities to regional areas, of course, mainly due to the COVID effect, but that growing trend and acceptance of people working from home or anywhere for the matter is becoming the norm almost. So there are lots of regions throughout Australia, but let's say the more popular ones offer, you know, strong lifestyle benefits like affordability, wide open spaces, good weather, and generally just a less stressful lifestyle.
Yeah.
So in New South Wales, the best known regions would be places like Byron Bay and surrounds, Newcastle, the Central Coast, etc., and similar regions in the other states. Now, from an investor point of view, I would be suggesting that we, you know, don't overlook that trend, and certainly the best way to get into those markets is to try and get in early before the demand becomes too overwhelming and indeed prohibitive. And also select those areas that are close to the hotspots like Byron Bay, because obviously they're going to be cheaper while offering the same sort of good benefits. Now, that trend, I think, will also have obviously an effect on an impact, I should say, on commercial property and how that's being managed. But yes, it's all very interesting.
Yeah, and you raise a good point there too, that I heard a great tip recently that the infrastructure you should be looking at, especially in the country areas, is not just road, rail or infrastructure, but is NBN, and looking at where the NBN's going, because one of the great saviors of COVID, or that saved us during COVID, was technology. And obviously I'm from the Proptech Association, so I'm a big fan of it. But what kind of tech did you see helping or being embraced in property investment and in the property space during that COVID period? And how did it help?
Well, I might start this one off. In our particular business, the technology really revolves around inspections and getting into property. And the greatest leap forward in that has been the ability to have tenant inspections and videoing. And that's probably likely to continue even when COVID ends, because there's a high degree of efficiency in that and not having people travelling out and about. And I think the other important thing, which might be worth a mention, is that technology might well play a big part in the way investment in property continues into the future, because If you read the reports, people are inventing things all the time to kill the virus. And if one of those inventions comes across the line and is relatively easy to manufacture and cost effective, I think that will actually be a game changer in the property industry, because obviously people will embrace that. So the answer is technology in our industry, in terms of getting out amongst it. The greatest move has just been able to use the video processor and get that collated back into your software system so that there's records for owners. And that's saved a lot of money, a lot of time. But just as importantly, has brought about better process for the tenant and the landlord at the same juncture.
Robert, what sort of technology have you seen being adopted?
Well, from our side, it really, if you think about what's had the biggest impact, is simply to Delwyn's point, being the ability to do what we're currently doing, and not only really the acceptance of this type of technology, and thus a way of working where there may have been a reluctance to do so in the past, and this has become our everyday way of life. It's you're used to having meetings with people, and their kids are walking around in the background now.
Dogs,
and I think
cats.
Dogs, cats, cockatoos. But so that really has, to me, it's been two things. It's been the use of the internet, and internet for, be it online ordering in all the aforementioned categories, Uber Eats, those sorts of things, as well as just being able to work remotely and connect remotely. And so really the main driver there has been access and data access.
So Jim, what are the end buyers expecting now with your developments in terms of technology? I mean, I think the whole buying experience really got changed during COVID, because you haven't been able to do what the industry always told you had to do as a buyer by going and inspecting everything manually and trying to cram all that time that you needed into your weekend or whatever. But what are buyers, what do you think the lasting impacts on buying is going to be?
Look, we all the things we used to take for granted, even things as simple as signing, sales contracts, have gone by the wayside. But on the positive side, our friends in the legal fraternity, who absolutely hate technology in a way, because they want everything to be done in its original form and so on and so forth. So with contracts and options and all those paperwork, all those legal paperwork that we have to sign, it's actually become a lot easier, because it's accepted now that online signing of documents is actually acceptable legally in most instances. So where before people used to have to go out and visit one-on-one to get signatures and so forth and do exchanges, we can actually do that all remotely, and that makes it quite easy to do deals. Now, the other thing, of course, is when the consumer is inspecting, I should say, properties. Well, the virtual inspections I actually love more so than having to go out. It's much easier for people to do a virtual inspection than it is to go out and physically, go through each property, and you try to, get to the places at certain times. You've got 15 minutes or 20 minutes to visit it before you run to the next one, etc. I mean, you can do it at your leisure, and if you really like a property, you can dive deeper and get more information before you actually do the deal. So look, again, I think what comes out of these crisis events are some very, very positive things. And as they say, when we need to invent things, because mother is the what's the word?
Necessity is the mother of invention.
Necessity is the mother of invention.
I think necessity is the mother of adoption, though, because to be fair, digital signatures have been around about 15 years.
Absolutely, I would expect that from a
virtual doers.
But certainly we're seeing that happening more and more as we speak.
Yeah.
But look, from an investor point of view, I want to just go back to that. I think people need to understand that the market is very, very well placed, and indeed there should be no fear in my mind because of COVID that we should not be investing. We are currently enjoying unprecedented times when it comes to property investment. And I'm talking here about the lowest interest rates in history. We have unprecedented demand and a lack of supply. We have a population growth that will increase exponentially, as we mentioned before, as immigration resumes in the next, say, 18 to 2 years. I know that the government is planning 160,000 new immigrations per year going forward. We have the most desirable country in the world to live, including some of the world's most livable cities. And yes, we will learn to live with COVID, right? So I'm very optimistic about the property market, and it continues to excite, and it will grow in the short, medium, and long term. So if you're an investor, now's the time to come in.
And one of the things that I think is at that cutting edge that we're seeing in the PropTech space, which is really interesting, that I'd love to get your thoughts on if you've seen them. But we're seeing a whole heap of new tech coming out that looks at different ways to buy or invest in real estate. So that fractional ownership, or even some new platforms that are supporting, especially the smaller property development end, that are allowing you to kind of invest your super funds into, lending money to developers to go out and build property and to make that easier for developers. Have any of you guys come across any of that?
Well, I certainly have. So fractional property investing has become very popular. And I think what's important to recognise in all of this process is that the underlying asset is still what you're buying. Yeah. So, and things like fractional investing and methodologies that have been applied by some pretty smart, entrepreneurs to make property more available to a greater mass of people. But the bottom line is always, it is the underlying asset. So the fundamentals of property is still there. You've got to think about location. You've got to think about the rentability of that asset if it's an investment. And you've got to keep, in my mind, an eye to what the future might be in property. And in that space, I think that we are going to see the classes of property separated a bit further. You might see that newer property might become more attractive than older property because it might mean more compliance with things like COVID and health regulations. And some people might gravitate to that because they might feel it's safer. Then you might have that class of property in the middle where those things can be added through forms of technology. So if you're investing into property, no matter the method, be it fractional, be it as a direct purchaser, or be it through some sort of aggregation process in a managed fund, you still got to think about what is your underlying asset and what your horizon is for investment. And I think to the point of both everyone on board, I think the risks are fairly low if that time horizon is medium to long term.
If I can chime in on that. Look, traditionally, Australia has provided many ways to invest in property, including, as we all know, the long-term buy and hold strategies using, negative gearing, etc. So investing generally in property is a relatively safe strategy, as we know, to build wealth. Indeed, about 80% of Australia's rich listers, as you probably know, hold their wealth in property. What is not so well known is that, that wealth, or a lot of that wealth, is actually achieved by investing in property development. We know that in the major capital cities and the regional areas, the federal and state governments are investing loads of money in infrastructure to encourage developers, in fact, to take up development opportunities in order to meet future housing shortages, which we all know is already happening. So these are growth areas that are well supported by transport generally. In most cases, these areas have been rezoned for much higher densities, high rise. But however, investing in property development has always been regarded a bit of a risk. And I want to address that, being a property developer. And the reasons, obviously, are these. It can take up to 4 or 5 years to complete a project. And if you're an investor, this can be of concern. And in doing that project, you have to take the risk of finding, the right site at the right price. You have to go through what can only be described as a very convoluted planning process. You have to do the construction, and of course, the market can turn during the project lifecycle. So there are some risks there. So what we've endeavoured to do, and I think we've found the solution in Versailles, is that we provide quality, relatively low risk investment opportunities for our investors in our projects and still achieve very high returns. So how do we do this? Well, we do it by doing only the front end of the development process. That is, we do the site acquisition, we do the planning approvals, and indeed we sell the site to another developer to build on receipt of the approval, on receipt of the DA, and pay out the investors. So there is no construction risk, there's no debt funding, there's no marketing risks to sell the apartments, and the whole process takes under 2 years. So it's a way to join those rich listers in that they used to have all the opportunities in property development, and now we're making it much more accessible to our wholesale and indeed sophisticated investors. So look, if you want more information or you would like to see some case studies, please book in for a one-on-one and we'd be happy to help.
Sure. Well, we're seeing too some really interesting tech coming out that is actually doing that site assessment and, and taking lots of and planning and pulling together all of the council databases so that you can actually upload plans and see quite quickly if things are compliant or what would make them compliant. Robert, what's your experience? Because you mentioned big data before. What's your experience been in adoption and maybe issues around data sharing?
Not really a lot of experience with respect to that. I mean, if you have a look, we deal with the institutional and wholesale investor market, and so it's a fairly sophisticated market and deals with large projects. So you would often have a professional team that are set up and running those processes. So not something that I can comment on, but I would, if possible, like to, Kylie, come back to one of your earlier questions, which just really spoke about, how do you invest? Are we seeing abilities to invest? And I think that the first thing is I'd like to agree with both Jim and Delwyn that property is a good asset class. I mean, it's got good tailwinds associated with it at the moment, and any of the headwinds that one can think of apply not only to property but also to all other asset classes. So you can't say that the one is distinct from the other. And property, as Jim and Delwyn have said, is performing well. With respect to exposure to property and the ways to get exposure to property, there are a number of those, and one mechanism would be through direct ownership. Another one would be through a debt platform, where another entity takes the developer essentially takes the first risk loss, or the first loss risk, should I say, and that enables an investor to invest in effectively the debt and become essentially the bank. And there are a number of those available to both wholesale and retail investors in order to get a foothold in the property market.
Okay, fantastic. Well, look, gentlemen, I'm sure we could talk about this all day, but I think we're going to have to call time there. Thank you so much for your time, Delwyn, Jim, and Robert.
Thank you.
Thank you very much.